Well, hi guys, this is Nikhil from clickcfa.com, and today I will be taking you through the difference between estimated value and market price of a security, which is a concept in equity valuation topic of your CFA L1. So without wasting any time, let's get started. I'll explain it with a very simple example. Let's assume that you are working as an analyst in a firm and a portfolio manager seeks your advice on Google. He asks you that whether he should add Google or not. So you build a financial model of Google. Let's assume that financial model be a DCF, which is discounted cash flow. I'll explain it later in the module. But let's for the time being, let's assume that you arrive at a Google target price of around $1,000, and the stock at that point in time, which is Google, is trading at around $800 in the market. So there's a clear-cut upside of around $200 according to your target price. So in other words, the security is undervalued. Now let's assume the other way around. Let's assume that you have arrived at a target price of 800, but the security is trading at 1000. So there is a downside of $200. So the security is overvalued. This is the key point which CFA guys are looking in for. If the estimated value or the fundamental value is greater than market price, the security is undervalued, which is the first case. On the other hand, if estimated value is less than the market price, that is the second case, the security is overvalued. One thing which we need to keep in mind is that estimated value can be in range. That is, let's say, according to your model, you can build a bear case or a bull case or a base case of a securities valuation, and according to that, there might be some range of that particular fair value. So in, let's say, in base case the fair value is around 1000, in bull case the fair value is around 1200, and in bear case the fair value is around 800, and you weigh them according to your weighings and calculate a point estimate or a interval estimate of fair value with a particular level of, let's say, confidence levels which you arrive at. So a 90% confidence level that the fair value lies between a particular interval, let's say 900 to 1000. If that point in time the market price of the security is greater than that particular band of yours, the security is overvalued. On the other hand, if market price is less than the calculated band of yours, then the security is undervalued. So I'll just mark it for you guys. I'll just tell you that if the fundamental value is greater than the market price, the security is undervalued. On the other hand, if fundamental value is less than market price, the security is overvalued. So that's it for today. I'll take up the valuation models in the next session. So see